Alibaba's earnings just plunged 66%. This could signal disaster for the tech sector worldwide. Alibaba, a cornerstone of the global tech landscape, just released shocking earnings. A staggering 66% drop in net income has sent ripples across the tech world, missing revenue estimates by a critical margin. If you own tech stocks, consider this your crucial wake-up call. What's driving this decline? How will it impact the tech industry and your investments? Here's the part nobody's talking about. We're diving deep into the complexities behind these numbers. With several factors at play, including fierce competition and strategic investments, the stakes couldn't be higher. Stay tuned to understand what this means for your portfolio and how to maneuver in a challenging market. Alibaba's latest earnings report didn't just grab headlines. It sent shockwaves through the financial markets. The company reported revenue of 284.8 billion yuan, falling short of the anticipated 290.7 billion yuan by almost 6 billion yuan, equating to significant missed opportunities. Net income plummeted to 15.6 billion yuan from 46.4 billion yuan a year prior, signaling deeper financial concerns. The immediate market reaction was a 5% drop in Alibaba's US-listed shares during pre-market trading. Here's the part nobody's talking about. Analysts at Citi and other financial institutions expressed their concerns, branding the results as softer than expected. Despite a 36% boost in cloud revenue growth, driven by AI initiatives, the gains are overshadowed by Alibaba's aggressive strategic expenditures. Their ambition to match US tech giants in AI and technology has financial repercussions, prompting a critical question. Are these massive investments paying off, or are they financial burdens in disguise? But the real question is, what does this mean for the stock going forward? Analyzing the data reveals a complex portrait of Alibaba's current financial situation. The stock price, trading at $129.87, reflects a minor increase of 3.5%. However, this cannot camouflage the looming red flags. While short-term cloud revenue gains seem optimistic, a deeper dig into the numbers reveals a stark reality. Net income is down 66%, and operational income has nosedived by 74% year-over-year. Here's the part nobody's talking about. Such heavy declines suggest that investors might be temporarily buoyed by superficial gains, neglecting to consider the gravity of Alibaba's underlying financial health. Continuous investments in sectors like quick commerce and technology pose risks that might outweigh temporary upticks in stock value. The optimistic market sentiment could be misleading, overshadowing the essential narrative of caution and pragmatism. Behind the scenes, Alibaba is one of many Chinese firms vying for dominance in the competitive AI landscape. CEO Eddie Wu has reiterated that AI is and will continue to be one of our primary growth engines, as the company aims to leverage its cloud intelligence group, which achieved a 36% revenue increase from AI-driven products and services. Despite impressive numbers, Alibaba's aggressive push into AI has financial implications. Since the start of FY26, Alibaba has reported $111 billion in revenue alongside a concerning. Here's the part nobody's talking about. Negative free cash flow of $4 billion, ending Q3 with a cash reserve of $42 billion. While they are not running low on cash immediately, the rapid pace of spending raises alarms. The potential consequences if AI investments do not yield expected returns could be dire. Moreover, rivals like Meituan are capitalizing on Alibaba's challenges, marking their own significant gains. This competitive pressure, combined with the geopolitical challenges facing Chinese tech firms, complicates Alibaba's path forward. But wait, the stakes are high, and the unfolding scenario could either present an opportunity for strategic maneuvering or expose Alibaba to even greater financial risks. Broadening our perspective, Meituan has surged by an impressive 14% in the Hong Kong market, contrasting with JD.com's steady performance. This stark juxtaposition highlights Alibaba's lagging position compared to its peers. A detailed sector heat map reveals Alibaba's vulnerability, as competitors seize the opportunity to capitalize on their setbacks. This shift in dynamics has prompted a growing bearish sentiment towards Chinese tech stocks, compelling investors to reassess their exposure within the sector. The market's watchful eye remains fixed on these developments, understanding that the competitive landscape could redefine investment strategies. Here's the part nobody's talking about. To navigate these complex waters, maintaining vigilance and adapting to shifting market trends is imperative. Examining the risks, we find a multifaceted landscape fraught with potential pitfalls. Increased scrutiny over Alibaba's ambitious AI strategy could erode investor confidence, especially if results fall short of market expectations. The critical challenge lies not only in catching up with U.S. tech giants, but also in convincing the market to buy into their long-term vision. Failure to deliver compelling returns could result in significant financial setbacks for Alibaba, exacerbating competitive pressures. Here's the part nobody's talking about. Global investors are increasingly bearish in the short term due to the escalating tensions in the Chinese tech sector, further amplifying these concerns. For long-term investors, this moment represents a pivotal juncture requiring careful monitoring and strategic reassessment. The risks, while tangible, also underscore the potential for informed maneuvers and opportunities amidst the volatility. The unfolding narrative warrants due diligence and a cautious approach. Looking forward, Alibaba's determined foray into AI investments presents a double-edged sword, a potential game-changer or an expensive gamble. For astute investors, this period demands a re-evaluation of their positions. Will Alibaba's AI strategy bear fruit, or will their heavy spending prove unsustainable? With substantial risk comes the possibility of substantial reward, provided these strategies are wisely managed. Tracking how these initiatives unfold in the forthcoming months will be crucial to your investment decision-making. Here's the part nobody's talking about. The path forward is fraught with challenges, but also laden with opportunities for those with the foresight to navigate it strategically. In conclusion, the verdict is one of cautious optimism. While Alibaba's trajectory is marred by uncertainty, the potential for growth remains if their AI investments succeed. The current situation requires investors to critically reassess their positions. The shock of the earnings report is palpable, yet so is the opportunity if managed judiciously. Investors must weigh these factors and decide their stance on Alibaba, making strategic adjustments where necessary. Here's the part nobody's talking about. Stay informed, stay vigilant, and be prepared to act. The savvy investors are already taking action. Don't miss our next feature on how Meituan navigates Alibaba's challenges. Decide your stance: bullish, bearish, or sidelined. Subscribe to Profit and Peril to remain ahead.